Well, wonderful. People are still trickling in. We're going to get started warming up. Good afternoon, everybody. Thank you for being here and listening to those wonderful panelists that the Climate Action Registry invited for us. We're going to be discussing price forecasting this afternoon. Yes, let's just get moving. I'll start by introducing myself. My name is Emilie Mazzacurati. I'm the managing director of consulting firm 427. We do work on California cap and trade, on climate policy, and on climate adaptation at large. I have with me four eminent experts in carbon markets and California cap and trade. Maybe I'll let you introduce each of you briefly, and then the agenda for today, let me tell you, is that I'll try to frame a little bit the discussion before leaving it to those gentlemen to tell you more about where they see the market going, and we're going to try to have an interactive discussion, so please move closer or closer to the mic and be ready, because you're not taking a nap right now. That's not happening. Brian, would you like to?
Okay.
Mic number 3. Would you like to go ahead? Just introduce yourself, yes.
I am Brian Murray. I'm the Director for Economic Analysis at the Nicholas Institute for Environmental Policy Solutions at Duke University. We're delighted to be working with CAR as one of the organizational co-sponsors of the event.
Good afternoon. I'm Michael Gibbs. I'm with the California Air Resources Board. I work on the climate programs, including the cap and trade programs.
And good afternoon. I'm Brad Neff, Senior Manager at PG&E for long-term energy policy, working on cap and trade and the market issues.
And Abyd Karmali with Bank of America Merrill Lynch. I'm Managing Director there and run the carbon market business globally.
Thank you. So as you can see, we have a great mix. My role as a moderator is more to ask questions, but as we started preparing this panel, pretty much everybody on the panel told me, by the way, we don't do price forecasts. And I figured some of you may actually want to see a price forecast. So I took it upon me to just bring together some of the leading price forecasts that are available out there and use that to frame the discussion and ask questions to the discussants to the panel today. So here's my little slide. Before I get into that, let's just back up for a second. It's coming up. But first, there's a big mix of attendance at this kind of events, and some of you know what I'm going to talk about very well, but please bear with me 2 minutes, because there are people at this conference who are not necessarily as familiar with carbon markets. And I just want to put things in perspective. When we talk about carbon prices, we talk about the carbon market. What are the drivers that drive carbon prices? So if you look at the carbon market, it's pretty much like any other market. Econ 101, there's supply and demand, they intersect, and you've got a price, equilibrium price. But when you talk about carbon, what's driving supply? What's driving supply is the government, that's Michael, allowances, and offsets, offset developers. There's many in the room and at this event. If you look at demand, demand for permits, for allowances, is driven by emissions. And so emissions are driven by whatever makes the power sector, the industrial sector do their business. So it's things like fuel prices and weather. It's things like how the economy is doing, demand for product, a number of factors that have nothing to do with carbon specifically, but drive greenhouse gas emissions in our economy. Right. Now, the tweak with carbon markets is that they're politically created market, and so policy and regulations are an extremely important price drivers. And so quite a bit of the conversation today is going to be about how policy is a price driver and how it's going to impact market dynamics. Now, onto my slide. What are other people saying about price forecasts? So I graphed 3 price forecasts from the sort of the leading analysts out there and economists. One is from Bloomberg New Energy Finance from their latest report dated April 2. One is from Thomson Reuters Point Carbon, my former employer, for some of you may know, from their latest report as well, carbon market analyst. And one is a paper that was put together by eminent economists at the Energy Institute at HAS at UC Berkeley. So let me tell you a little bit about what I'm showing you. So in blue, you have the price floor, the reserve price at the auctions at the bottom, the bottom line. And up top, you have the price containment reserve, which is tiered, and so it's showed as a sort of a range, a price range, where prices are not supposed to get any higher. So that's what's in the regulations as of now. In the middle, I graphed the various price forecasts, and we're going to focus on the solid lines for now. The highest price forecast is the one put together by Point Carbon, Thomson Reuters. The one in the middle is Bloomberg, so they see prices going up to roughly $50 in 2020. Point Carbon sees that going to at least $60. And then UC Berkeley, I try to illustrate what they're doing, but they don't actually provide a price forecast. What they do is they say prices are going to be either at the floor. The probability is that, the most likely is that prices will be at the floor. There's an 80% chance that prices will stay at the floor. And there's a 20% chance roughly that prices will be at the price containment reserve or higher than that. And it's not going to be in the middle because there's no abatement. So those different price forecasts are driven by different assumptions and a lot of very sophisticated modeling that I'm not going to get into because that's not the object of today. But we're going to bring those back up and talk about, okay, what are driving? There's different assumptions on offsets. There's different assumptions on the role of complementary policies, different assumptions on how much internal abatement, how much emission reductions within California under the cap sector we're going to see. Different assumptions on how linking with Quebec is going to matter and how the long-term view is having an impact on prices today. So these are the kind of elements that we're going to be discussing and that are driving those different price forecasts, and we're going to get back to those. But without further ado, I'd like to let the actual speakers talk about price forecasts. And so we're going to be having this conversation. So Michael, what do you see as a key driver for the market?
Okay, great. Thank you. And I'll be turning to this board resolution in a moment, but don't focus on that just yet.
Right,
so you can even go back to your forecast. Thank you, and thank you to CAR and the sponsors for having the panel today and for having me on the panel. As Emilie already pointed out, the market for carbon and for allowances and offsets in California and the California program is driven substantially by how the program is designed and what the program requirements are. And the program has been up and running, and I think for the most part, people understand the program and understand the supply of allowances and what the compliance requirements will be. What I'd like to talk about is one of the areas where there's continuing work, particularly in the area of cost containment, and what the board has directed the staff to do on that. So to introduce that topic, I just want to give a little bit of history about the program and where it comes from. Of course, this program comes from the statute AB 32, the Global Warming Solutions Act of 2006, and that commits California to reduce our greenhouse gas emissions back down to 1990 levels by 2020. State policymakers have also articulated an aspiration for even deeper emission reductions by 2050, presumably as part of national and international efforts to address the risks of a rapidly changing climate. So AB 32 does not require, and I don't think anyone would expect, that the state would consider making emission reductions at any cost, but rather there is some idea that we're going to make emissions reductions that we can afford. In fact, AB 32 says that the board shall adopt rules and regulations that achieve the maximum technologically feasible and cost-effective greenhouse gas emission reductions. So this phrase cost-effective actually appears at least 9 times in the 13 pages of AB 32, so it's a very important part of the charge to ARB to develop a program to reduce emissions. And I think that we can say with some confidence that ARB's charge is to develop a program that is cost effective, that we're not going to move forward to reduce emissions at any possible cost. So as a market-based program, the cap and trade program is itself inherently a cost-effective type program. As emitters trade allowances back and forth, the emissions can be used in their most highly valued uses so that emissions are reduced in the most cost-effective manner possible. But I think beyond that, and one of the more interesting things about a market-based program like cap and trade is that the market price is a very public and immediate measure of the marginal cost of reducing emissions under the program. You can see transparently what this program is costing. And that's a market signal, that's a way that we can keep track of whether we are actually achieving the objective of reducing emissions in a cost-effective way. So unlike other programs, we have a very ongoing and transparent measure of cost. So given that cap and trade is inherently a cost-effective approach, there's specific parts of the way the program was designed to enhance further the cost effectiveness. And I'll just give a couple examples. First of all is the concept of banking of allowances, the ability to hold allowances and use them into the future. The banking enables less costly emission reductions to be performed early in the program, reducing the need for more costly reductions later. I think we're going to come back to this banking question as part of the discussion. We also have the opportunity to use real, additional, and verifiable emission reductions from sources not covered by the program to offset emissions that are, in fact, covered in the program. These are the so-called offsets, or offset credits. So our ARB analysis and other analyses that others have done really show consistently that emission offsets can help control the cost of the program, bring the overall cost down, and that when we think about what are drivers of the likely outcomes, where do these price forecasts come from? Are they going to be in the high range or the low range? The availability and price of offsets is an important factor. Another aspect of the program is 3-year compliance periods, providing some flexibility on when allowances are purchased. Well, while these program features help enhance the cost effectiveness of the program and keep the costs down, there are conditions that could occur that could lead to high prices, and some of them are represented in the forecasts up on the screen here. So that can lead us to ask the question of, well, how costly is too costly? What's acceptable, and where do you draw the line? And there could be different answers to that question depending who's looking at it and what you're trying to determine. But for the current cap and trade program that's designed through 2020, there is a policy that has been clearly articulated publicly, which is that the highest acceptable prices are defined by the allowance price containment reserve. This is the reserve. It's again shown there in the big blue bar at the top, where allowances are set aside that are available only to emitters covered by the program, and those allowances are available for purchase at set prices, and the upper bound is the upper bound that policymakers have determined as acceptable for the program. That price starts at $50 per metric ton this year and increases at 5% a year through 2020. The reserve has about 122 million tons, which is a fairly substantial number. As a comparison, the current emissions that will be covered by the program this year is on the order of 160 million. So the reserve covers about 3/4 of a single year of emissions this year. So it's pretty big. Nonetheless, some have suggested that the reserve could be depleted, and if it were depleted, then the program would be vulnerable to prices that are even higher. There's a committee that the Air Resources Board has established to help examine these types of issues called the Emissions Market Assessment Committee. They've done some work in this area and have emphasized that it would be better to know now what AARB would do if this happened to come true, that the reserve were to become depleted, rather than wait and see if it actually happens and then figure something out. So their advice is figure it out now, explain it publicly now, so that everyone knows what the rules will be, and if you're purchasing and planning to hold allowances, you'll know what would happen in the event that such a circumstance would occur. So taking that advice, the board considered the issue last October and provided direction to the staff, and that's what's on the slide. So the board adopted a resolution, and I just want to emphasize a couple points in it. It's actually on 2 slides. We'll just stick with the first one there. First, the board did restate its policy about the objective of what the highest allowable price is. You'll see that it says there that the mechanisms should ensure that allowance prices will not exceed the highest price tier. So that, again, makes that basic policy statement, what's a highest acceptable price, restated and known. It goes on to say that there are some conditions in figuring out how to do this, that we are to minimize the impact on existing allowances so that if investors have purchased them and plan to use them in the program or buy and sell them, that they do not get adverse impacts through whatever mechanism, and that the mechanism maintain the environmental objectives of the program. That's particularly important because the objective is to use the market to reduce emissions, and we don't want to have mechanisms that just prevent that objective from being achieved. So finally, on the next slide, I also wanted to emphasize, you'll see there toward the end, that the board did not ask that we develop an approach that is designed for all conceivable future conditions. Rather, directed the staff to focus on what you see there as a range of, a reasonable range of plausible combinations of conditions. In other words, what are we really going to be protecting against, and focus on developing mechanisms that will be effective there. So I don't have an announcement today. I do not have a proposal from the staff. The staff is working with this committee, the Emissions Market Assessment Committee, and stakeholders and others to develop proposals. A public workshop has been announced for May, not a date yet, with a target date of the board taking this up in October. So that's, I think, an important development in the regulation and the program that's underway. Also recently, there was a list of other activities that were announced for consideration. Most of those have to do with affecting the manner in which allowances are allocated to emitters, how they're given away for free, on what basis, and in what quantity. That's, of course, of crucial importance to those emitters, but does not change the total supply and really does not change the market dynamics very much. There is one item also on that list, which is about the Air Resources Board adopting additional offset protocols. Given the importance of offsets, in cost containment, monitoring that activity as a development of additional protocols to strengthen the supply of offsets into the future is another important thing to keep track of. So I'll mention that as well. And then I'll stop.
Right. Thank you, Michael, for highlighting the key ongoing regulatory changes that are going to impact both supply and demand for the market. And then we're going to come back to that, and I'll quiz the other panelists on what they think. But for now, I want to turn to Brian Murray from the Nicholas Institute. And you've done a lot of work on the policy design of those markets. So what's your take on the California program?
Well, sure. Well, thank you, Emily. A lot of what Michael said, I was going to say. The good news is I probably had more than 5 minutes worth of things to say, and Michael said it much more eloquently than I would have. So, but I am going to pick up on a couple of key themes, and just to point out that I'm going to be focusing on the price collar, but I want to, which is a broader sense of what Michael just talked about. But just to put it in the context of there are many different things a part of the California design that are focused on the objectives of cost containment. In other words, keeping this program, as the term Michael used, make it affordable. There's the complementary policies, there's offsets, there's allowance banking. The market linkage agreement, starting with Quebec and perhaps wider than that. These are the kinds of things that actually, the bigger your market is, it gives you opportunity to bring lower cost mitigation in. And if it's spread enough, it also should reduce the volatility of the market. But I am going to focus a little bit on the price collar because that's what I've worked on most from a design standpoint. And I think, and let me just, don't worry, there won't be a test on this. I usually have to say that to my students. But so this is the price collar mechanism, which isn't, I don't know that the term collar is actually used in any of the language of the bill. But essentially it builds off the two core components of the price containment. The first being the floor, the price floor. So if you don't look at the green and the red stuff on the chart here, you think about, here's a market, and if you kind of ignore offsets for a moment, here's a market that has a fixed supply and then bouncing demand that Emilie alluded to. So in California, the kinds of things that will shift allowance demand aren't always the most predictable things in the world, like how much snow did you have in the winter? How's that going to affect your water supply and hydro? How hot is it going to be in the summer? How's that going to affect your demand for power? So these things can bounce all over the place, and if you have a purely fixed supply, then the prices are going to go all over the place. So the mechanisms that we talked about on the previous slide are things to help smooth this out. And as an economist, I'd say to turn that vertical supply function into something a little bit more horizontal. So the elements of design that help with that are the price floor. So the price floor being the auction is set up, at least currently, where you don't auction, you have a reserve price in the auction, you don't sell anything for less than $10. So that puts a price floor on. And then you go up to the other end, and this is what Michael is referring to as the allowance price containment reserve. And this is the notion that you can add allowances to the market. You can sort of add a supply function with some slope to it, to the market at the higher prices to satisfy some of those shifts in demand. And everything in between there, sort of the market is free to roam. And that's the notion of a price collar. You've got an absolute floor, and in California's case, your upper level, your ceiling is what I would call a soft ceiling, because it is not currently constructed to be an absolute guarantee of being able to have a price ceiling, but it's provisions in the regulation that allow new allowances on the market that will soften the blow of higher demand. And so I think as we get to the broader policy discussions, we might want to revisit that. I think that's one of the things that's on the table. Normally when we look at markets, we don't fret too much about volatility. There's markets for millions of different things out there, and prices go up and down. If you're a buyer or seller in that market, you're worried about it. But from a public policy standpoint, you just sort of say, buyer and sellers beware, derivative sellers come in, and things like that. But this is a different animal, and Emilie alluded to it in her opening comments. This is a market that is essentially created by government policy. So some would argue that the government has a responsibility to make sure that that market operates as well as possible, that it gives people, and because it's set up in a way with a lot of uncertainty. You set a cap, you do all this great economic modeling, you think you know what it's going to cost, but you really don't know what it's going to cost. So you need to put provisions in place to handle that eventuality. And we've also seen in emission trading markets, whether it's the SO2 program or the EU ETS program, we've actually seen a lot of volatility in these markets. And so we can anticipate that California, without any special provisions put in place, would likely have volatility as well. And the market's participants need confidence. So this is not unlike the way things were in 2007 at the federal level, when congressional staff came to me and my colleagues at the Nicholas Institute and said, we're designing a cap and trade program. We understand this trade-off between price uncertainty and quantity uncertainty. We want to have a fixed quantitative target like they do in cap and trade programs, but we're concerned about volatility. One of the recommendations that's put out there is a safety valve, which would be like a hard ceiling on prices. We're concerned that would mean that you would just issue a lot more allowances when the market's tight, and therefore we would break our environmental goal. What should we do about that? And so over the course of some months rolling into years, we went down a few dark paths and came up with a few different ideas. And then we came up with, in collaboration with some of our colleagues at the Bipartisan Policy Center, Billy Pizer in particular, who's now, he must have liked us so much he's actually come to work with us. And we came up with this idea of an allowance containment reserve in the federal legislation. Well, what a wonderful design element of a policy that didn't pass. And so, we kind of joked to ourselves, how much credit do you take for helping to design a failed policy? But before too long, folks in California had heard about it, and they knew that we had some role, and they wanted to see how it might work here. I've talked with, I don't know if some folks from Reggie are in the room. I know they're on the platform or in other talks, but they've also they're putting some of these design elements in Reggie. Of course, Reggie has a price floor. Right now, it's hard to think about this high price risk in the markets that we're in right now, but back when we were working on designing this in 2007, it was hard to think about low price risks. So that's why the notion of a collar is a good one, I think. So in closing with my comments right now, I think California's now in the position of, this mechanism's in place. No secret, no one's, the reserve auctions have not, they haven't issued any allowances because no one really wants to buy $40 credits in this environment, but it's there. So, but as you look forward, there are a couple of design questions to ask. Should the upper part of this collar be hard or soft? I mean, should it Should it be as it is right now, which is offering a little bit more at higher prices, or as some might argue, should it be offer whatever the market needs at some set price to guarantee that? Okay, that's a question. It's not a recommendation or comment for me. And the next question might be, is the collar, is it too loose or is it too tight? You know, it's 10 to 40 is roughly what we're looking at right now. That's a factor of 4. Some people might think that that's a bit wide. Some people might think that that's just right. And then, of course, the other question, and Mike alluded to this, I'll just close with that, is how do you populate this reserve? If you deplete the reserve as it is right now, what do? Do you just issue more allowances? Do you try to borrow some from some future period? What are the options on the table? And I'd be happy to discuss that or entertain questions in the Q&A. So.
Great, thank you, Brian, and we will have a chance to get back to those issues. But for now, I want to turn to Brad from PG&E. You're the emitter on the panel. You get to speak on behalf of 650 facilities in the state of California. When you look at the market, what do you look for?
I don't think that's what we want to be known for at PG&E, the emitter on the panel. I was going to start out by saying that I didn't want to go into PG&E's history and talk to you all about PG&E's environmental leadership, but maybe after that comment I will.
Any excuse will do.
But we have partnered with other companies and are working collaboratively with ARB and appreciate their collaboration on this effort. And I think it's worthwhile to call out the civil discourse that happens between the regulated and the regulator in California, especially in the political climate that we find ourselves in the United States. So it's been a very productive, and thank you for that working relationship. But I do want to jump right into what PG&E sees are some of the tweaks around the edges that still need to be taken care of in the cap and trade market that overall we see as very well designed. And those are the allowance price containment reserve, offsets, and banking. And so what I'm about to say has been said by others, and so I will nip and tuck as I go along. But first, I'd like to talk about the reserve. And as currently designed, it leaves prices uncapped when the reserve is exhausted, as you've heard. I'll just add to what the others have said that if you put Emilie's first slide together with what Michael said, what we have is, so the Emissions Market Assessment Committee, made up of professors from UC Berkeley, Davis, and Stanford, gave the suggestion that we have a harder price cap so that the market knows what the ceiling is for certain. And they also came out with the study that Emilie showed that there was, if you read the footnote, there's an 11% chance that we'll exceed that, in their view, that we'll exceed that cap. So we at PG&E and with other compliance entities joined together to do an experimental economics market simulation. And this was led by Jan Mazurek of ICF, Bill Shobe and Charlie Holt of the University of Virginia were the primary academics, and then Thad Hudeman of PEAR led this effort. And similar to the assessment committee, the simulation study concluded that there is adequate justification for further research into different forms the reserve could take. And I'd just add that linking with other jurisdictions make this kind of policy more difficult, and it makes it more difficult to have a robust contingency plan. So the conclusion for the APCR is that reinforcing the reserve is required to make it an efficient cost containment mechanism against significant and sustained high allowance prices. Second is offsets. Now the offsets limit is set currently to make up some of that gap for those allowances that were taken out of the general fund and put into the reserve. However, while the allowances when purchased out of the reserve can be used at any quantity at any time, for compliance, the offsets can only be used at 8%, and that's a limit that's per entity and per compliance period. So I'm just interested, I'd like to take an informal poll of the group here. How many people here, by a raise of hand, feel that California will reach 8% of their compliance through offsets? That's what I assume. Nobody.
Or they're asleep.
What's that?
Or they're asleep. Or they're sleeping.
Or they're
Either
sleeping.
No hope
How many feel that it'll get above 4% or half of that limit? Okay, so some.
they're awake.
Good, you're awake. So we talk a lot in this conference in particular about offset supply, and I think it's important to note the challenges in demand as well and look at the full picture as far as offset usage. Offsets, as Michael alluded to, have a big impact on prices and can be a very effective price containment mechanism as long as they're used in the market in sufficient quantities. And then finally, banking. Banking in the market is theoretically unlimited. However, holding limits create a large inequity between the compliance entities as far as their banking capacity. So if we talk not about holding limits, but about banking capacity, the smallest emitters can hold in their holding accounts 20 years worth of emissions, while some of the largest emitters can't even hold 1 year's emissions. So this inequity in banking capacity may actually increase the risk of market manipulation and limit the ability of the largest compliance entities to mitigate that risk, both for themselves and for the market. So again, in the experimental economics work that we had done, they showed that holding limits can have a significant negative impact on market performance. And so in reality, if holding limits are reducing liquidity in the market, it may actually be increasing the risk of market manipulation, which is what holding limits are designed to prevent. So using holding limits as a protection mechanism against market manipulation neglects in large part their effectiveness as a cost containment mechanism. So again, in my view, the cost containment mechanisms is the final piece of the puzzle needed to ensure against very high prices. And of course, what we've heard over and over again with the California market, the purpose of the market is as much to influence other jurisdictions and to spread this kind of thinking and this kind of solution to other jurisdictions. And so to do so, we need to ensure that this market functions properly. Thanks.
Thank you, Brad. And as you can see, policy drivers keep coming back as a key element of how price is going to be shaped in California. So Abyd, you've worked for one of the biggest banks in the world. You flew from half around the world from London to be on this panel with us today. You have a lot of experience with the UTS. When do you look at the California market, what strikes you most? What are your thoughts?
Well, I mean, the first thing is my sympathies go out to anyone who's in the forecasting business because, you know, in the early stage of a market where there exists so many uncertainties, and we've already heard about many of these, it is a really tough task. And I think, you know, what's clear to us, and perhaps will come clearer from some of my comments, I think that there are still lots of uncertainties to be sorted through, lots of variables that are in play that could take prices one way or another. And I guess, you know, the key message for anyone in the forecasting business is do it often so that you can continuously update your forecast. But I mean, maybe what I should say at the outset, since I know there are several people in the room that may be asking the question, what actually does a financial intermediary do in this market? I could just say a few words about that and then get into some of the key areas. You know, from our perspective, when we look at the California market or any carbon market around the world, is there an opportunity for us to help intermediate on risk? So in other words, offer risk management solutions to compliance entities or others who are interested in taking positions in the market to hedge some of their longer term carbon exposure? Is there an opportunity to facilitate some of the offset development that we've heard about as well that's so key to keeping the prices down? And you know, examples of that would be some of the nimble project developers that have already begun working at speed in California, but some of which need capital to help scale up their operations so that they can deliver some of the offset supply that everyone is expecting. So that would be an example of where we might come up with a structure that could help deliver capital to them in return for taking some of the price and volumetric risk. And you know, those are the basics of what a financial intermediary does. whether it's here in California or elsewhere. And I'm happy to say that one of the reasons I came here is that we are seeing lots of interest in those kinds of services, and we've already undertaken some transactions that illustrate those sorts of services. So how does this fit in the bigger picture with a global financial institution? Well, in our case, this activity is part of global commodities, which sits within banking and markets, and we would like to think that carbon is a mature commodity that performs in the same way as, say, the oil market or the gold market, and that's certainly how we organize ourselves. We have trading personnel who focus on the short-term market movements, and then we have personnel who focus on some of the longer-term transactions, where you might be doing some of the longer-term deals to help manage price exposure for some of your customers. And that we call origination and structuring. So that's how we've organized ourselves. We are certainly set up to do that in California. And we expect that California will become a very mature carbon market, and we see many of the core elements already in place. I should say also, in keeping with the fact that we are such a large company and we have a footprint in California, that Bank of America at the corporate level has a $50 billion commitment to mobilize finance to address climate change over the next 10 years. And so there is a link between a day-to-day business and kind of a broader corporate initiative. So moving now to what we see as the early considerations about what's driving prices. In simple terms, we see it as a 4P kind of analysis. The first one is policy, and we've heard some of the critical elements of policy that are still being bedded down, whether it's the complementary measures that are going to deliver, we hope, some emission reductions that will impact the reductions taking place in the capped sectors as well. And that is a crucial interaction that maybe we can come back to. Another example would be linkage. We talked about Quebec already a little bit, and that's, I think, a very positive decision that's been made to link with Quebec. There could be linkage to other systems internationally. I know that you probably, Michael, have many visitors from overseas, trying to talk up trying to woo you to potentially link with them. The third area would be potential interaction between the cap and trade program and how auction revenue is spent through the Clean Energy Investment Fund. Is that the right name? I think that's a really important initiative, but again, there could be some overlap, let's say, with supply and demand for the capped sectors. So that's policy. I think I said there were 4 Ps. So the second one is procedures. Now, this may seem bureaucratic, but actually, the kinds of decisions taken on resource shuffling, on even information disclosure through kits, could have an impact on how the markets evolve, what participant behavior is. And I think, Brad, you already gave a sense of that with discussion on holding limits. The third P is practicalities. Now, this I would describe as the behavior of different types of market participants, because you're going to have a range of participants with different risk profiles, with different hedging strategies. How some of that plays out in the market will fundamentally dictate whether you have, let's say, smooth behavior on the price, or whether there could be some bounciness. And then the fourth one is potential. And that I would summarize as being the potential of non-carbon suppliers to deliver significant amounts of power generation, for example. And a great example in California is all the details around the nuclear plant, the San Onofre nuclear plant, and the degree to which that comes back online. And we've already heard about hydro generation. That's very relevant in California as well. So weather factors into things too. And of course, the potential of the offset developers to really come through with the supply that everyone's looking for. So that's a kind of an overview from our perspective.
Great, thank you. And I'd like to open to questions, so you can start getting ready and moving towards the mic if you have questions, but I'll use my moderator's privilege to ask a first question to the panel. So we've heard about policy drivers a lot and about fundamental drivers in the power sector, some. And I'm wondering, when you look at the market, at prices today and at prices over the long term, do you think that they're more driven by policy drivers or by some of those fundamental drivers? Are they really not playing a role? It sounds like policy is really driving prices right now. Do you have thoughts about that? Brad?
Yeah, my thought there is that, like you said in your opening remarks, this market is made from policy, and supply is determined by policy, and who can play in the market is determined by policy. So it's policy, policy, policy.
Three Ps, all policy. Okay.
Yeah, I think it is hard to separate policy from the fundamentals when the fundamental is that it's driven by policy. But I still take your challenge, I guess, to say, so prices, when I left my hotel room, they were trading around $14.10 a ton or something like that. Well, that's not the floor, right? So, and yet there's a sense that there's probably plenty of allowances in the market right now to handle the compliance responsibilities, although it's unknown because it's April, right? I suppose that some sort of combination of the floor and the ability to bank is what's keeping prices, I suppose, in that range. And any great accumulation of knowledge that says 14 is the right price now, and I expect it will be 15.20 next year and 16.10 the year after that. So I do think that there are elements of the policy design that are help anchoring the prices where they are right now. But I think there's going to have to be a lot of more market experimentation, and there has to be actually a true-up period and a period of compliance, I think, for there to be more knowledge about what sort of the right price is.
Yeah, I think that's a really crucial point, that actually we're very much in price discovery mode. We've had 2 auctions, and congratulations in terms of how well they've turned out, and in terms of the coverage ratios. But I think the experience from all of the market-based programs around the world, whether focused on carbon emissions or fishing quotas or sulfur dioxide or whatever, is that it takes at least 12 months and 1 true-up period, crucially, to see, what the consistency in pricing is.
I'd like to add just one other element of the discussion of the importance of policy, and that is the importance of policy stability. So it's one thing to say that policy is important. I think it's also important to recognize that if you had a policy that's changing faster than a market can react, or that investors can accept, or that is faster than the return people are expecting if they're buying and holding any of these instruments, that would lead to rapid failure. So policy stability is important, and predictability. So I mentioned there's some program adjustments that are being considered this year, and we've tried, in the way we approach them, is to be clear that we're getting guidance to do them, that we announce well in advance what's being considered, that we make the considerations open and transparent as possible, which is generally the case in rulemaking in California in any case, but particularly here, where we're not just talking about companies that may be required to put on a piece of equipment in response to a command and control regulation. We're talking about a market that is operating and depending on a stable environment in which to make decisions. We really want the policy for the program to remain as stable as possible, and that's why we go out to 2020. That's why we have these various rules about banking and the like, so that they can be used into the future. And we don't want to change those things because we don't want to add any uncertainty about any lack of stability in the policy.
And if I can just say, I mean, we have some perfect examples of policy instability in, well, I guess the 2 other markets, in quotations, around the world. So some of you will be familiar with what happened in European Parliament on, whenever it was, a few days ago, may have been yesterday, But the decision on backloading, which was to extract a bunch of allowances in the auction profile and sort of stick them back later in the decade, that sort of tinkering is really dangerous in terms of stifling investment. And as you say, Michael, companies are taking long-term investment decisions with, in some cases, assets that have 30, 40-year lifetimes. And so what tends to happen is they will delay and delay making those investments until the risk premium reduces. And the other great example is Australia. And I know we have some Australians in the room as well. But the fact that the proposed shift from the carbon tax in Australia to a free-floating price, which is supposed to start 3 years from now, is still subject to this big political instability, is obviously putting a damper on any transactions at this stage.
Great, thanks. Are there any questions from the room at this point? The mic is yours. If you don't mind, there are mics in the middle of the room, and that way it will allow everybody to hear you. If you don't mind standing up and... Yes, and if you could please introduce yourself when you start. Go ahead. We have another question coming up.
So,
Bud, if you can introduce
hi,
yourself.
I'm Bud Beebe with SMUD, and I think what we're hearing here is like people just pissing all over the unknowns of the future, right? And if I go to a different forum, like if I go to an API convention or something like that, it's like the people who have to reduce their greenhouse gases, they're unhappy too, because there's like all of this uncertainty. And I just wanted to take a second, Mike, and say that the ARB has been wonderful in a couple of ways. Okay, you're hard to deal with in a lot of others, but wonderful in a couple of ways. And one of them is this ability to project forward what the issues are and to conduct this stuff in public and to let people know. So with that great buildup, tell me, what's on your mind for the staff policies that might be under consideration that could give a little more of a solid cap to our current price reserve soft cap? What kind of things? I mean, right now, for instance, the price reserve actually borrowed from the cap in the future or throughout the whole cap regime through 2020, right? And you're making those available under this special thing. So that wasn't actually reducing the cap. That was just making them available here. And then you came up with offsets, right? Are you thinking about something that isn't actually going to reduce the cap at all, but maybe just borrow? Or are you thinking about actually, making this cap softer too?
So thanks, Bud.
Right? Yeah.
Obviously, I don't have a proposal to present today.
Right, right.
And if I did, I wouldn't. But I think the direction from the board has some important things to emphasize. First, as a cost containment mechanism, we don't want to do something that tightens the market, tightens the cap, just to put more allowances in what would appear to be a bigger reserve, because then you've just taken them from here and stuck them there. So that doesn't really help. That would not, I think, promote the objectives that the board has suggested. The board has directed for us to try to maintain the environmental objectives of the program. So one approach, for example, that the Emissions Market Assessment Committee, the EMAC, mentioned, just create a hard price cap. At some known price, you'll sell as many allowances as anybody wants to buy. That would be, I guess, what we call a hard cap of some sort, or a safety valve of some sort. And that would certainly achieve the price objective, but could lead to abandoning substantially the environmental objectives of the program. So that would have to be weighed. So how are we going to balance these things? Where are we going to get real emissions reductions, real credits of some sort that we could add to the reserve to make available in the event that the prices are getting high enough that the reserve becomes at risk of being depleted. That's the question the staff is focusing on, and doing that in a way that minimizes the impact on all the existing allowances. We don't want to devalue, we don't want to affect the investments that people are making, but we want people to know that these are the maximum prices that we're targeting here. So if you're trying to invest to manipulate the prices up to higher numbers in the hope of making a big score, that's something we're trying to not allow. And if the fundamentals are leading the price that high, that's more than we think we can afford. So we also don't want to allow that. So that's what we're wrestling with. Those are the directions from the board that we're working with to develop a proposal.
The interesting thing here that I'd like to add is that setting that hard cap, or that safety valve, does ensure that the market won't go above, and does pose some risk that we exceed the cap. But it also, if you argue that the price containment reserve is set properly, and we're not going to use that full quantity, then setting a hard price cap actually reduces your risk of hitting that soft price cap, because now you don't have that incentive of those exorbitant prices.
So in a little bit different, sort of like a particular way, do you think it's do you think it's more important to assure that we have a functioning market that's actually learning how to regulate itself and put all the pieces together in a way that works in a great way, or to preserve a number that was identified several years ago now? In other words, can't you consider moving the cap just a little bit in order to preserve order in a market that has ultimately a great deal more potential benefit than preserving that last 100,000 tons of CO2?
Right, so these are trade-offs, right?
Right.
Among the different objectives, and what's the right policy that values these different things, one of which is trying to ensure that the market itself can operate well and doesn't become more subject to manipulation than it otherwise would be vulnerable to, and can proceed in an orderly way. And would we want to, if we could be assured of getting that by missing our environmental goal by just a whisker, wow, that would be a nice trade-off to get. But we have to examine what the trade-offs are and what you're giving up this way or that. One thing we're also mindful of, not that this is the sole factor, but we are mindful of, we're trying to do this in an environment where people are watching us very closely with tremendous scrutiny to see what works and what doesn't work, and what would be a good model, and what might they want to take from this and improve on it. I think we've had the opportunity to look at what others have done and build on that and try to improve, and I'm expecting others will do the same with us. So we're trying to also do that within that context of trying to put forward an approach that we think would be a good example that others would also want to consider.
I'd like to, if I could, I'd like to add a comment about not what California's objectives are, but why you design these types of collar systems. And the idea is that these things get activated when unusual events occur. So it might be a year with particularly, in this context, California context, a year with particularly low snow melt and very high demand for power really pushes allowance demand way up. It is not, and so you've got this, whether it's a fixed safety valve or it's an allowance containment reserve, you have some recourse against the market moving that way. If you are constantly running up against that reserve price, the trigger price, the high end of the range, then what you've got is a fundamental issue of whether, where the market's allocated. And it's a signal to policymakers if the policymakers are saying in advance $40, $45, $50 a ton is awfully high from our standpoint, and you're constantly hitting that every year, it seems to me that sends a signal back to the policy process that says, I guess we may want to reevaluate the cap and where it is and whether it's affordable. But that this device should not be seen as the permanent solution to a market that is out of balance in terms of supply and demand. And the same could be said on the other side of the market as well. If you're constantly at the floor, as some of the systems right there that have floors are operating at, it makes you ask the question, are we, in a long-term sense, sort of over-allocated? Do we need to have all these emission allowances, or should we pull some back? And that's what I think. That's what I think these things do. They sort of trigger a potential revision of the long-term policy, or at least a revisiting of it.
And I'm going to jump in here and sort of maybe take us a little bit in a different direction, but you just brought up other systems and how they've been dealing with an excess of allowances compared to their emission levels. And in California, everybody seems really worried about prices going up, yet at the same time, the forecast available out there looking at certainly 2013, potentially 2014, seem to indicate that there might be more, that the market might be a little long, that there could be a little more allowances than emissions in the early years of the system. Why aren't people worried about prices being low in California?
There's a price floor.
There's a price floor. That's one element of an answer. Is that the only reason?
Well, of course, current prices take into account the expected future value, and the EMAC paper that says that there's an 80% chance that those prices will be at the floor, it doesn't mean that the prices will be at the floor, but that when you take into account all the future possibilities, that's what the percentage is, but you're going to weigh that all against the other possibilities, and it's going to come out, you'll probably see a price in between there.
Yeah, I think it's two factors. It's the fact, you know, that you could have this significant range depending upon things like the weather, the success of the other complementary measures. And then, as you say, it's the expectations about how tight the cap might be in, I suppose, in this case, the post-2020 era. And all traders will assign, you know, some probabilities to all these different outcomes and come up with their view on what pricing is, and that's what creates the market.
Yeah, the only other thing I would emphasize in that, which is when you have a belief that scarcity in the future will lead to a higher price, then you're willing to buy and hold today.
Yep.
And so that brings us back to the banking thing. And in the analyses that ARB has done and that others have done, there's always an expectation, consistently in these analyses, that in the early years of the program, a bank is built up by some folks buying and holding. The holding limits that Brad brought up before need to be examined in the context of whether they allow for this banking to occur in sufficient quantity to enable an efficient allocation over time, the so-called intertemporal efficiency of banking now and using later, and whether the holding limits are an impediment to that. That's one of the things that the study he mentioned was specifically examining. So it's something we have to keep looking at. But coming back to the basic question, the extent to which emissions are a little lower than what the allowance budget is in the first few years, I think that's expected, and that would lead to this bank that could then be used in the future.
I wanted to add one thing to that and actually tie it back to the previous question too about concern about going over the limit. Well, CO2 is a stock pollutant, right? So it isn't necessarily something that happens in this particular year. Climate change is caused by the concentration of CO2, not the emissions of CO2 at any one point in time. So that's why you want to have the type of flexibility that banking brings to the table, which allows you to move emissions from one year to the next without any, as long as you've got a fixed budget, you're not having a big impact on the concentration. That's also why you might allow, going over budget in a particular year in response to a crisis, but you would be very concerned if that kept on recurring over and over again, because then your stocks start to build up, your CO2 stocks.
Great, thank you. So I want to turn to the room again, and thank you for your patience. And
Sure.
Please go ahead.
Lisa Weinzimmer with San Francisco Public Press, and my question is to first Michael Gibbs. Does resource shuffling impact allowance prices? If so, how? And related to that, I understand CARB is reshuffling its definition of resource reshuffling. Can you say why and say a little bit more about that?
Sure. Thanks for the question. Resource shuffling. So resource shuffling, for those who are interested, refers to the fact that for electricity that's produced outside the state of California, but transmitted into the state of California, that a substantial portion of that power that comes in is from an unspecified source. You don't know exactly which facility it came from. And that's the way it has been and will be. That's the nature of the way the electricity market works in California. So in AB 32 and in the regulation, we try to take care of that by applying emissions obligations to all electricity that is entered into the state, whether it's produced here locally or whether it comes in from the outside. So shuffling has to do with those facilities outside the state that are not known precisely, just rearranging essentially on paper where the power appears to be sent to. So the lower emitting power could get sent to California, the higher emitting power could get sent to Nevada or Oregon or Arizona, and it would look as though we had real emissions reductions when in fact it was just shuffled. It's called shuffling because you're shuffling the contracts and there's no real change in what's happening. So this has been an issue since the beginning in the design of the program, and we've tried to address it through various definitions. And when we adopted the regulation, a little more history, we prohibited shuffling. So shuffling is prohibited. And one of the things that came up as we were implementing it, and we could thank folks from the various electric utilities, including PG&E and others, pointed out that our definition, although nice and concise, really wasn't sufficient for those who are trading electric power to know whether what they're doing was engaging in shuffling or not engaging in shuffling. So it wasn't precise enough to enable folks to know that they were complying with the regulation. So that's a important problem to solve. So we worked last summer pretty hard to solve that problem, and a series of public meetings and the like, and ended up with a proposed definition of what we call safe harbors. These types of things are not shuffling, and these other things are shuffling. And we tried to define them precisely and tried to make them consistent with the terms and conditions under which the power markets work in the West. And by the time we ended up with that proposed approach, I think we had pretty good consensus among all the different participants in the electricity market that this was a good, precise definition that they could, in fact, operate under. So that guidance was produced last October. It was published and was used this year in the program. And I think what you're referring to is the announcement that we're going to take that guidance and now integrate it into the regulation. So the process of taking that guidance and putting it into the regulation is a regulatory amendment, but it's essentially codifying the guidance that was developed last fall. So there's no change in the definition since the program started. It's just codifying it into the regulation.
For Brad, Neff, how does this codification impact PG&E's ability to comply overall with cap and trade?
Well, if it happens just as Michael said, he's taking a guidance document and putting it into regulation. So we've been working according to that guidance document, so it won't change anything as far as our practices today. It'll just be codified, which will be nice. But one point to make on this resource shuffling is that, maybe not so much on resource shuffling, but we are seeing now the carbon price embedded in the electricity markets. And so this is kind of what you'd like to see, right? In markets, you'd like to see that there is a price, there is a cost associated, or a price associated with the carbon that you're emitting. And so we're actually seeing that. And so in our practices, that goes into the overall. And the CPUC says we need to get the lowest cost resources to sell to our customers. And so this becomes a piece of that. And so that's one of the things that made it difficult in the beginning, is we've got the CPUC regulation that says we need to use the lowest cost. We expect a carbon price to be part of that electricity price. And so those cleaner sources are going to have a lower carbon portion of that. And so this was needed to help us to comply and to operate.
Right, and so are you saying the cleaner prices are coming from associated with out-of-state resources? I'm just
No.
not making the link with reshuffling.
Just that now we understand in our operations what is resource shuffling and what is not resource shuffling, which allows us to operate in a least cost dispatch manner according to the regulation by the CPUC. So it marries the two up and we can comply with both.
Thank you.
Thank you. And the mic stays open if there's more questions, but meanwhile, I'll jump in. We've been talking a lot about the power sector, and naturally that's one of the key drivers in the market right now. But in 2015, the picture is going to change quite a bit with the inclusion of fuels under the cap. So I wanted to ask my panelists what were your thoughts on how that was going to change market dynamics and whether power was going to become irrelevant or still remain a driver. Abyd, would you like to, sorry.
Yeah, no, I mean, I think, you know, that becomes, if you like, the big bang event in the California market where suddenly the number of sectors covered expands significantly. Anytime you introduce new sectors, you then get a wider array of marginal abatement costs, so that should be more efficient. You also get a wider array of hedging behavior, you know, participation in the auctions. So again, generally speaking, you'll have, you know, the open interest will increase. So you should have more efficient markets, and I think that's a really important aspect. But of course, the pricing, you know, that's relevant in that phase of the market may change fundamentally too, because all of a sudden you may have a set of players who are perhaps more short than others may be, and we know that the allocation to, for example, the fuel providers is, you know, everything has to be bought. So that should create a surge on the demand side, and the question will be, will there be availability of things like offsets by 2015 to help mitigate some of that? And will that then dampen some of the potential price increase?
Brian?
Yeah, I agree with everything Abyd said. You know, the way I look at this too is, so you're going to bring new demand onto the market, but you're going to bring new allowances onto the market. And the real issue, and you are going to get more efficiency because you're going to have more sectors trading. But the sectors who are being added are sectors that you typically think of as being perhaps relatively less responsive to price than, say, the power sector, which has some ability to do some, you know, redispatching and whatnot. But transportation fuels, for instance, you know, when we do all the modeling in the federal legislation, you know, they're what really push up the demand because, as we've seen, if it translates to the price of a gallon of gasoline, you know, until things hit the magic mark, which it's been at around the last few years, I mean, the consumption of gasoline doesn't change very much. And so if it's a more unresponsive part of the market, those are the types of things that end up putting upward price pressure on, where you do need these other mechanisms like offsets. You do need technological advances in all of the sectors that allow you to have a greater response to prices and a greater ability to reduce your greenhouse gases in response to the carbon price. And that's what kind of drives changes in technology and changes in behavior that are going to be necessary to help bring these prices down.
Thanks. Brad, what's your take? Is that something you're looking forward to or dreading it?
I just have this phrase continuing to go through my mind that Abyd said, and I pity the poor forecaster. You know, it's going to fundamentally change the market, I think. You look at a 2.5%, not 2.5 times larger market in 2015. Oil and gas majors become the major player in the market at that time. And the auction revenues going to the states are expected to grow quite substantially. So it just becomes a very different market. And when you look at the supply, there are a few things that supply is known, as written in the reg right now, and a few things that can change are the usage of offsets and if and when we dip into the price containment reserve. So those things on the margin can have a big swing in the actual prices that we see.
And I want to,
I would
yes,
just
go ahead.
emphasize, Brad, one of the things you said, which is that currently, in the current version of the program, we have a relatively small number of large emitters with a big compliance obligation and then a larger number of smaller. Starting in 2015, we have a small number of enormous emitters and some big emitters and then some small emitters. So as you said, the nature of who the biggest compliance obligations are with, what those companies are like, their sophistication and capabilities, I think is important for us to understand and be prepared in terms of how we monitor the market, how we watch the market, and make sure it's operating efficiently.
And I also want to ask you, Michael, in the list of regulatory amendments that ARB is working on right now, there's something about fuel providers and how they're going to be regulated. We know that some of those fuel providers are not very excited to be capped starting in 2015. Is that a done deal? What is ARB working on right now, and could that impact the market?
So the scope of the program is set for 2015. Like many aspects of the program, there are those who are continuing wanted to improve it or adjust it, and some are concerned about the fuels being in the cap in 2015. At this time, that's the program design. There's no direction to change that in any way, and that's not something that's planned. What is under consideration is that for the companies that distribute natural gas to small commercial and retail customers, they operate under CPUC regulation and behave very similarly to the way electric utilities that distribute electricity to commercial and retail customers do. And we developed a allowance allocation approach for the electric utilities that keeps the value of the allowances in that sector to be used on behalf of their ratepayers. And it's been suggested that we should look at that example that we used for the electric distribution utilities and assess whether we should be applying that same method to the gas distribution utilities that are distributing natural gas to these commercial and small commercial and retail customers. So I think that's something that there's interest in. Again, it wouldn't change the supply and demand, but it would affect how the value of the allowances got distributed and enables them to be used directly on behalf of the ratepayers for those fuels.
Great. We have a question, Mohammed. Go ahead.
Hi, my name is Ahmed Idris. I work for Capital Power, and we're an electricity generator. Can you hear me?
Yes.
And
you might want to introduce yourself again. I'm not sure the mic was on when you
Okay,
started.
my name is Ahmed Idris, and I work for Capital Power. We're an electricity producer. I have a question about the cost containment or the price cooler. How long do you think that the price cooler or the cost containment will be part of the carbon market? And I'm looking at, do you think this will stay until carbon becomes a world-traded commodity? So for example, if you look at the oil and gas, oil, for example, doesn't have a cost containment curve. You can trade it up and down, and actually the market would adjust itself based on consumption. Or natural gas, when it was, for example, $14 or $20 or $12 per gigajoule, there was no cost containment curve to bring it back down. So is that the reason that the carbon market has that cost containment, because it's not globally traded? And once we pass that period of time, testing time, we think, or there is going to be more linkages, we think that the price, the cost containment will not be a part of that carbon market? Thank you.
Go ahead, Brian.
I'm not sure I got all of that, but I think it was basically about the fundamentals of what pushes the price around and why is it, if it's different than other commodities like oil and gas, why? Is that in a basic gist of the question, or?
I'm trying to find how long we're going to continue to have a cost containment curve. Is the reason that we have it for the time being because it's actually carbon is not globally traded and we have to address local needs? That's why we have the cost containment curve. once it moves to become more globally, we're not going to need that cost containment anymore.
Well, certainly, yes, certainly the bigger the market is in terms of, if you could trade compliance instruments from a lot of different sources, then that tends to have a stabilizing effect on price, all else equal. Of course, it does open you up to shocks in all those other markets, but by and large, the ability of different market players to come in and satisfy your demands is going to keep prices from going too wild. And so there is a global market for oil, right? There's essentially a single world price, although it's got some, variations based on grade and some based on location. But there's essentially a single price for oil that we quote as dollars per barrel. And that, that's because there are so many players in the market. Well, we still see radical shifts in oil prices sometimes, but that's often based on news about what the economic future is going to look like. Like a bad jobs report might actually push the price of oil down pretty considerably because there's a sense, well, maybe the economy's not going to grow as much as we thought, which means that demand for oil is going to be lower than we thought, which means that the price is likely to come down in the future, et cetera, and so forth. And when you think the price is going to come down in the future, anything that you can trade across time is going to have an instant effect on the price today. So in some ways, carbon acts like that. It's a compliance instrument. You have to use it today, but you can also use it in a future year if you bank your allowances. And everything is kind of based on what you think it's going to take for you to meet your compliance requirement if you're an emitter, what it's going to take for you to meet your compliance requirement at the time that you have to meet that, at the true-up period. And if you get new information on the fundamental driving factors like things that affect electric power demand or things that might affect transportation demand, they're going to work their way into the price fairly quickly. And the real question is how much supplies are going to be elsewhere in the market to be able to respond and keep that price from going too wild in terms of its swings. I don't know if Abyd, if you want to.
Yeah, it's a very interesting question actually, because I mean, I think part of it is that we are in this transition phase in carbon markets globally. We only have, we have at least 40 countries, I guess, with existing markets or markets under development, and that's that's to be applauded in terms of the overall effort to address climate change. But it's still very patchy, and there's only a few years of history with these markets. So part of it is that policymakers, I think, are they want to start with baby steps, and having cost containment on both the collar approach is a way to to ease into a market. And to make sure that companies in one location may not be adversely affected in terms of relative competitiveness compared to others. But my expectation is, I think what you were suggesting, that eventually we should see cost containment phased out, but that will be several years, possibly even in the next decade, once there's much more of an architecture globally for carbon pricing. I say when, not if. Anyway.
Optimist again. Anybody else on that question? Is there any other question from the room at this point? You have only 10 minutes left, I am told. So, well, I'll jump in with another question. I want to come back to a point that Brad illustrated quite dramatically earlier with regard to offset supply and the fact that there's a broad expectation that there will not be enough offsets in the market. And yet the economist in me want to say, well, if prices go up, shouldn't the offset supply respond and follow, and shouldn't we see more offsets on the market? And so I'm wondering where you see that dynamic going, and if you think that offsets could play a more important role down the road, or what would it take for offsets to play a bigger role on the market? Go ahead.
So, if the allowance market is all about 4P, then I think the allowance market. Then the offset market is about 4 Ls. You can see this was choreographed on the plane coming over.
Planted that question.
So, the first L was the lawsuit, and I guess one should say plural, right? Lawsuits. But, the binary nature of and I forget exactly the name of the lawsuit, but the one focused on offsets, had a massive stifling effect on potential transactions in the offset market. So one hopes that now that's receded, we should see service as usual. The second L is, of course, liability. Now, in California, there is a quite particular design element on offsets, which is the buyer liability aspect. And that, I think, is challenging in terms of how the offset market will evolve, because it will mean that there is going to be a fragmentation of the types of transactions undertaken. That doesn't necessarily need to lead to lower supply available. It just means that it probably is going to take a longer time for there to be a fully developed offset market as people begin to experiment with different types of contractual arrangements on the liability issue. And that leads to the third L, which is liquidity. So we see in the offset market some challenges in terms of how frequently these offsets can turn in terms of the market volume, and that's problematic for, say, an organization like us, because my management, you can imagine, it's risk and credit and tax, and everybody wants to weigh in on any particular deal. And what's really important to a financial institution is to see price visibility on a commodity. And the challenge when you have a fragmented market is, of course, you have lower liquidity and you have less visibility on pricing as a result. And we're still in that phase in the offset market. I'm happy to say we've managed to find ways to address that, but it's a very important characteristic. And then the fourth one is location. And here, I guess, it's less of an issue in terms of fungibility of the way the protocols are defined and developed. It's very clear, very transparent. The process, I must say, is much more efficient than a certain other global offset mechanism. But there could be some interesting aspect on location with can you bring in offsets from Quebec into California and vice versa if there are some differences on treatment of some of those issues that we talked about, and also the whole big question about red plus credits coming from sectoral mechanisms in locations outside the US. How is that really, well, will it materialize, and if so, at what stage in the market?
Great.
I think, too, we've come full circle. You talked about policy and fundamentals, and offsets is a great example of the cross-section there. So markets find where supply and demand cross and find their equilibrium very well. But for offsets, there are some supply challenges, the number of protocols that are approved, the length of time it takes to approve those, and future forecasts and expectations of offset supply. And then on the demand side, litigation, the limit, 8% per company per compliance period, and the buyer liability. So there's uncertainty on both sides of that, and policy plays into that, to both sides of that equation.
Great. So I'd like to use the last 5 minutes, seeing no burning questions in the room, to use the last 5 minutes to ask you for maybe some concluding remarks, and in particular, if you have any thoughts on what's coming up down the road, post-2020 in particular. If some of you have mentioned the expectation of post-2020 and how that was driving prices maybe even today, yet there's no cap yet. And maybe, Michael, you can start by telling us a little bit what the path forward is on the regulatory side, and then the rest of the panels can talk to how they look to post-2020 in particular.
Well, sure, thanks. And thanks for no easy questions today from anyone. And appreciate the discussion. Of course, we at ARB and in the state of California, and working with our colleagues in Quebec and other states and provinces, are really focusing on getting the program up and running and successful, and going through the tweaks and other adjustments that we work with our stakeholders and participants to do. But we do also have to look out into the future, and AB 32 does require that the plan that California put in place to indicate how we would achieve our emissions reductions. It's called the scoping plan, be revised every 5 years. So the scoping plan is currently undergoing revision and redevelopment, and there's a public process addressing that. And so that will be further illuminating the outlook into the future. And so certainly participate or stay tuned for those developments. AB 32 does envision a continuing emissions limit in the state of California. The authorization does not end in 2020, although the program as currently designed goes through 2020. So the cap and trade program as one element of the scoping plan would also go through revision and development for the post-2020 period. Hasn't started yet, okay, but stay tuned. Yeah.
Great. Brian?
You know, so when I think about where California sits now and looking out to 2020, I think, you know, California is both sort of lucky and unlucky in two forms of timing in terms of, you know, getting this program off the ground. It's tough, as I'm sure you can attest, it's tough to get something like this off the ground in the type of economic environment in which we're operating. I tend to believe that the federal legislation failed. The most important thing with the federal legislation might be the day that Lehman Brothers shut down. I mean, you know, it just sort of created a cloud, and it was hard to do something so dramatic. So that was the unlucky part, but I think the lucky part, or the beneficial part to California, is they were able to construct a program and learn from the lessons of other markets, whether it's the EU ETS or RGGI or from other air pollutants. And I have to say, I've made the trip out here a few times in the last few years. I have a tremendous amount of respect for what the ARB staff has done in terms of incorporating that knowledge. They have a tough job. They have different constituents here in California than we do in other parts of the country that have to be satisfied. But I think they just did a tremendous job of learning from all the design issues that others struggled with in other settings and tried their best to make it work for California. So I'm fairly sanguine about how this is going to work for California over the next few years, because I think they've done everything in their power to make it work. And I think that will set the right platform for moving beyond 2020. And ever the optimist, I'm hoping that we're in a much brighter economic environment, not only in California, but in North Carolina and Europe and everywhere else, so that this does seem like something that is not only that we should do, but that we can do.
Yeah, and just following on to that, looking beyond 2020 and in the longer range, I won't give you any price forecasts. I'm not an analyst, and thankfully that's not my job. But I think there are some positive signs, and I too am an optimist. And I'll go back to the point of the civil conversation between the regulated and the regulator. I think too much in today's policy discussions, we think if there's a civil conversation there, that the regulated is getting everything they want. And I assure you that's not the case. But it's a civil conversation, and it's a productive one. And so as we see these challenges coming down the line, and post-2020 will be a big one, I'm confident that we'll be able to work through those and have success in the long run. And another important point to remember is that we're not building a market to build a market. We're building a market to reduce greenhouse gas emissions. And in the final account, the success or failure of this program will be in emissions reductions, emissions abated, emissions avoided. And so the way forward to significantly impact global emissions is to create a market that's going to work in every scenario and that can be exported from California.
Great, thanks.
I think
Get the last words.
No, very, very wise words from everyone. My three colleagues here. I think, you know, California, you know, I did my graduate studies in the US and then worked here for a while on the East Coast. And California has always been a model. And I know people in Europe look at California as a model as well. And I think what California is doing with this program, not just the cap and trade, but as you say, Brad, the broader focus on moving towards a low carbon economy is seen internationally as exemplifying green leadership yet again, and doing so in a way which, you know, demonstrates there's, you know, not much conflict at all between trying to achieve the environmental goals and doing so in an economically efficient way. And I think maybe the final point I would say is, when you combine the P and the L, of course you get a P and L. And fundamentally, it's about how quickly companies can internalize, the cost of carbon into their operational decisions, into long-term asset planning, and hedging is a part of that. And hedging carbon exposure, just as you would hedge foreign exchange or interest rates, that's I think the value added that we hope to be able to bring to this as a financial institution is as the market gets its greater growth, say, as we get closer to 2015, certainly by 2020, we would expect this to be a very professional, very mature market with very sophisticated risk management solutions, and obviously we would love to be a part of that.
Great. Well, thank you for this very illuminating remarks, and please join me in thanking our panelists. This concludes our panel for today, and we're available if you have questions. Thank you.